Welcome to the Dividend Talk podcast, episode 186, a deep dive into evolution gaming.
Dividend Talk is your number one podcast for all things dividend and stock market related, community oriented, and with a European flavor. However, for those of you interested in delving deeper into specific topics, we also offer a premium service. This service is centered around our newsletter, featuring in-depth analysis and special subscriber requests, but also offers dividend safety stock cards, access to our beta dividend safety dashboard, and an e-learning course on how to interpret the 3 financial statements. If you haven't become a member yet, feel free to sign up for only €119 a year. Additionally, we extend a warm welcome to our latest subscribers. But let's get started. In today's show, Wolf of Harcourt from Ireland is joining us to perform a business breakdown on Evolution Gaming. It's one of the fastest growing Swedish companies in terms of revenue, profit, and what we mostly love, dividends. So learn everything about what the company does, how it earns its money, and what opportunities and challenges lie on their horizon. Ready? Let's get started and enjoy the show.
European DGI, another Friday, another podcast.
Yes, and this time we're on time, and I hope you have got your phone turned off so that we don't have interference again like last week when we had to record everything all over again on a bloody Monday morning after a heavy night also in the weekend before, together with the meetup, right? So no, all good here. Just before the show, I was talking about Eurovision and all the songs coming in. We're Europeans. We're a Dividend Talk podcast with a European flavor. So I'm really looking forward that, and specifically this year, the Dutch submission is really, really bizarre, but actually quite catchy. But I must say also the Polish version I listened to this week is also really nice. So there's some good stuff in there, actually.
Yeah, May 11th, I believe, is the Eurovision.
Yes.
So, yeah, I always like it. It's like a guilty pleasure of mine. I do enjoy the
Exactly.
Eurovision. So. Hey, but this week we are going to be talking about Evolution AB. We know it's a company that you've spoke about, maybe wrote about a little bit before. But we have Wolf of Harcourt Street on the show today. Welcome, Wolf.
Thanks, guys. Thanks for having me on.
It's a pleasure to have you back. It's the second time. I believe you were last on in episode 48. So that was a long time ago now.
Yeah, that's it. And I'd say there's probably a couple of thousand more listeners since then, so no pressure.
No pressure at all. But as you said, we do probably have a bit of a larger audience now. So maybe for those that haven't gone back as far as episode 48, maybe give us a brief introduction about who you are and what you do.
Yeah, so I'm a private investor based in Ireland, like yourself. I work full time, so investment is a hobby like us all. And my investment strategy would be a combination of dividend and growth stocks. So I don't favor one over the other. I look at the whole suite of stocks.
Awesome. Look, we don't judge you for having the growth part of your portfolio. But look, I've read some of your articles. You do have a Substack, and you do lots of these deep dives. You do lots of your portfolio analysis as well. We'll put a link. I recommend you check out that Substack. But looking forward to talking to you about Evolution AB. I know you're quite passionate and you know quite a bit about the company. But before we get on to that, what about the news, guys? Is there anything this week that kind of popped out at you?
Yeah, so I've got some news, and it's quite relevant, I guess, to your audience. And I coin it tech turns to dividends.
Ooh.
So this week, Salesforce, ticker CRM, initiated a dividend of 40 cents per quarter. So it works out as about 0.5% yield. And Booking Holdings, ticker BKNG, initiated a dividend of $8.75 per quarter. And that works out at about a 1% yield. So I think it's quite interesting that, these growth stocks, tech growth stocks, you'd probably call them not so long ago, are now initiating dividends. And I think it really comes down to the maturity of the businesses. they're probably not growing as fast. The capital requirements for CapEx to reinvest in the business are probably slowing down. And it's just now a matter of returning that excess capital to shareholders.
Yeah, and this we see a lot, right? We've seen this with Starbucks in the past as well. Once the growth starts to slow down, it's also a matter of like, can you reinvest in the business at a let's say a high return on investment? So typically, it is like if you start seeing that your internal return, let's say, starts to be below 10, then well, you could argue give it to your shareholders, right? Maybe they can do better business with it, with the money. So yeah, it's typically a sign of a maturing business. And I'm just waiting for Google. Do you think that Google will? I was thinking it would do it probably earlier than Facebook, but something is stopping them.
Yeah, so I think when I was last on the show in 2021, I kind of mentioned that, some of my stocks didn't have dividends at the time, but I expect, in 10 years' time, 5 years' time, as I develop as an investor, my stocks will also develop and they'll start paying a dividend. So even since then, Meta has initiated dividend. I think Amazon and Google, I'd be surprised if within the next 5 years, if not sooner.
Yeah, definitely, and Google, I think, has to, because somehow they are not so shareholder focused here, more on their own, and I think it has to change, because also with the latest, Gen AI mishaps, let's say, I think it's time that they get the act a bit together. And I'm a shareholder there, so I wish them to start returning some capital to us in the form of dividends. So I'm biased.
Yeah.
Time will tell. Time will tell. Well, let's see if they follow the likes of Meta. But speaking of dividends and dividend hikes, we've got quite a list of companies again that have some big dividend hikes. I'm going to start with two of your favorites, European DJI. Munich RE has hiked their dividend by 29%. That's a big one. And the NN Group had hiked it by 15%. You must be happy.
I mean, and ASR is also 7%. So, and these are three European insurers.
Yes.
Yeah, and Allianz we had also the week before, I believe. So the insurance sector in Europe is on fire with dividends. It's unbelievable what they are doing. They have so much cash coming in, and people are worried how that would look like in a higher interest rate environment. But we know that insurers do better with this. Yeah, the concept of float start to kick in. So yes, they may need to write off on some of their bond portfolio or something like that, but those are, how you say it, not necessarily cash flow impacts. Yeah, if they just keep the bonds to until maturity. So this is just like, it's just cash generating machines at the moment. They are on fire, and what they are doing really wisely is to use buybacks. Yeah, because the buybacks here, so if they do a hike of 15%, but buy back shares at the same time 5-6%, then the real net yield, net increase is much lower, right?
Yeah,
and that's what these guys are doing here, and they're doing that really, really smart to not overshoot here. And yeah, I really like it. I just wish I bought more Munich RE at the time. Yeah, I've got shares, but the position could have been bigger. Yeah.
Yes. Of course, we analyzed them on the show way back again in one of our early episodes. And looking back and listening back, I wish I bought more back then too, because I mean, it's incredible. They've a really consistent track record, but they're mixing high dividend yield with high dividend growth, and that's something that it's like a unicorn for us.
So. Yeah. I mean, you get the NN Group was 8% or something like that, and then a hike of 15%. I mean, it's crazy. Here you have quickly 10% yield on cost.
Yeah. Couple of other companies to run through. Bunzl hikes their dividend by 8.9% to 68.3 pence per share. And CRH PLC, a lovely Irish-owned company, hikes their dividend by 5.5%. I'm quite happy with that one. And then Defama, of course, hiked their dividend by 5.6% to 57 cents per share.
Yeah, and that one I need to look a bit further into, because I believe they have funds from operations in the last year around, let's say, 9.5 million.
Yes.
And I believe they are aiming for 12 million next year. Funds from, but I don't know if this is assuming a flat share count, because if so, we're talking about a 33% potential increase here. That would be too wild. Here, it's a high quality company. CEO was here on the podcast one time, right? So I'm very happy that I'm invested in it. Does everything right from what I see. So yeah, dividend will follow also a bit more in the future one day, I think.
Yeah, I think so. Another fan favorite is Van de Velde. They hiked their dividend by 5.5%. I think their annual reports are quite interesting. If you
I'm waiting for the 2023 one. This will be like I will for sure make sure that my wife is not around when I'm reading it.
Repsol hiked their dividend by 30%, and so did Aegon, also another 30% increase.
Yeah, another insurer.
Yeah, another insurer. Linde hiked their dividend by 9% to 139 per share.
Yeah. And then Eaton, yeah, also 9%. I saw somewhere they have 101 years of consecutive dividends, not dividend growth, right? But just paying dividends. It's insane. But I think General Electric can say that as well, because they cut the dividend at the time from probably 25 cents to 1 cent. So that they can say that we have been paying a dividend for a century. But still, it says something, right? And then Fidelity National Information Services, they cut the dividend by 31%, and they did this really sneaky, right? They didn't mention it like such, because what they usually do is they say like, we pay now so much dividend compared to this last year, and the whole comparison to last year was gone. You really had to discover it yourself that they cut the dividend. I mean, come on, who are they trying to fool? Dividend investors? It's not possible.
It's not like we don't have the whole World Wide Web at our fingertips.
Exactly.
Yeah. And then how about Cbus? They keep their dividend flat at 90 cents per share.
Yes, and this one is for me a bit of a vote of confidence from management, because this one was tricky. They had paid the year before 99 cents, heavy debt loaded, this company. So for people that don't know what Cibus Nordic Real Estate is, they are a real estate company, also in Sweden, but they focus on groceries, supermarket chains. So very, very stable business, but it came at a cost at the time, very debt loaded. And they are focused on paying down the debt a lot. So this dividend is really on the edge this year as well. But the company is very clear in what it is trying to do, and it pays a monthly dividend. So there are not that many in Europe. One of the few. And I'm a happy shareholder with it. It's a high yield play, with an anticipation that they continue focusing on bringing the debt down to get a proper credit rating, and then return to growth. That's kind of my story here. In the meantime, I get a proper yield compensated for this, and I would say, share price generally attractive, but I wouldn't recommend this as someone's anchor in the portfolio. Called such a stock from the edge of the portfolio, let's say.
It's more risky, more of a high risk, maybe high reward company to have. But look, again, some high dividend hikes, but at least we're starting to see some middle of the road dividends here. We didn't see that last week or the week before, so we're starting to see some reasonable hikes.
They have more time to think about it, right?
Yeah, they listened to our podcast last week, that's all. So Evolution AB, Wolf, as I say, welcome to the show. I know you wrote an article about this company probably last year, I'm going to say, and I'm not sure how much it's changed, so I'm looking forward to getting into it. But maybe you can give us a little bit of a background about Evolution AB. What did they do? How did they make money?
Yeah, thanks, Derek. So I wrote an article last October, an investment thesis on that. So a lot of the information in that is still relevant, albeit it was after the Q2 results. So you've had two more quarters of earnings, but I guess the qualitative information is pretty much still relevant in that article. But what do Evolution do? So they specialize in the development and production of content for online casinos. So it's a business to business. So their clients are casino operators rather than the punters that are actually gambling or betting, if that makes sense. And notable customers include DraftKings, Paddy Power, so that would be one that we'd be familiar with in Europe, FanDuel, MGM Resorts, Wynn Resorts. So a lot of these physical casinos now that are branching on to online as well. So I guess anyone unfamiliar with online casinos is kind of, to try and get an image in their head of what exactly an online casino is. And it's really just bringing the casino experience to your homes through internet connected devices. So the games themselves are hosted by qualified dealers and feature real-time playthrough and high-quality video streaming. So I would actually recommend going on YouTube and just putting in Evolution Gaming or Evolution Blackjack or Evolution Poker, and you can actually see the videos and how it all actually operates. So that's really how you get a view of what exactly is online gambling, because it can be hard to grasp if you're not familiar with it.
But how should we see that, maybe for the people, right, to visualize it? I guess they have somewhere a room in a building as a television studio. They put a table there, let's say blackjack, and there's just a guy or a woman standing there doing the blackjack, and then people are online connected via the internet, watch them via the camera. But is it an interaction? Can they talk with each other somehow, or?
Yeah, that's exactly it. It's almost like a film studio, as you put it there, a full set, and then you can interact with other players. You can interact with the dealers themselves as well.
Yeah, awesome.
And then I guess some of the highlights are things to note about an online casino. So they provide a full realistic casino experience. To professional dealers. They're real dealers. It's not a computer, it's actual dealers. It's interactive, so the technology is advanced, it's immersive, and it's very social. So you're interacting with other players, you're interacting with the dealers themselves. The game variety is the big one. So you can have all your classic games, your blackjack, your roulette, your poker, all at the fingertip. There's no walking around within a casino to get these games. You're in a lobby and you're just moving from the game to game. And the transparency and integrity is another one. So there is third-party audits to ensure that the games are run fairly and stuff like that as well.
Yeah. So I mean, we speak about giving an online experience for the casino world, but what kind of problem does that solve? Like, who's it aimed for? Is it aimed for like extreme gambling addicts, or like, what is it solving? I mean, I could go to a casino if I really wanted the real experience.
Yeah, so this is probably one of the biggest benefits of an online casino versus your physical casino, and I would call it's the house edge or the return to player. So the house edge is basically, how much of €1,000 does the casino actually return to players? So with physical casinos, you're talking about 70% to 80%, because they've got all of these fixed costs of operating a physical casino. But with the online casinos, the return to player is north of 90. You're talking probably 95%. Some of the games, it's 99%. So that's huge. Like, I can only really see the gambling move towards online, because I'm not a gambler, but if I was, and I could get that return online versus going to a physical casino, like, it's a no-brainer.
But you're still losing. You just lose less.
You just lose less.
Yeah. But I'm taking at it from someone who has done this, right? And I do like to gamble a small bit, not as much as what I used to, of course. But going to a casino is good. You're there. It's an experience. You're not really there to make money as such. You're there to enjoy it, particularly if you go to Vegas. Whereas online, when we were doing it, we were trying to make money. And if we lost, and not if, when we lost, we were more likely to say, oh, this is fixed, this is rigged. And you said that there's third-party regulators, but how does it keep people coming back if they keep losing money? It's quite a tough question, because I mean, as I said, I do like this, but I don't do it anymore, because eventually you do realize you lose money, and then you're thinking about this company as a growth company, as a dividend company, and the only way they can keep growing is by people coming back all the time.
Yeah, so what they do is the games portfolio that they have, they're continually developing new games.
Okay.
So their games really are in probably three categories. RNG, which is just like your your slots. So if you think in a physical casino, you pull the lever, the numbers come out. That's some other games. Then you're onto the live casino element. So your poker, your blackjack, baccarat, games like that. But where they're really making themselves differentiated is the live shows. So this is really what I'd consider the cross section of entertainment and gambling. So full studio production, games like Deal or No Deal. So rather than watching it on TV, you're actually playing the game in real terms, and it's technically gambling, but it almost feels like you're paying for entertainment, if that makes sense.
Yeah.
So one of the things that Evolution say that their competition isn't really other gambling sites or anything like that, or other gambling suppliers. It's actually entertainment, like Netflix. Netflix is one of their competitors. They're competing for your attention.
Oh, interesting.
Yeah, that's very interesting because, growing up in the 90s, we would always wait till 8 o'clock in the evening or something like that, or 7:30, and watch those game shows, right? Wheel of Fortune and everything. And yeah, I can definitely see something in there, specifically in the entertainment part here. And yeah, and to your point, Wolf, then it's not so much about losing money, but paying a fee to be entertained, right? And that's indeed a total different paradigm when you think about it.
So then where does Evolution AB sit within the gaming industry? Like how has it evolved? If they don't consider other betting sites, how has it kind of evolved over time?
Yeah, so the company was founded in 2006 by Jens van Baar and Fredrik Osterberg in Stockholm and Sweden. So they set about really revolutionizing the online casino by combining like the convenience of online gambling with the authentic atmosphere of a physical casino. So at this stage, online gambling wasn't really a thing for a variety of factors. Firstly, the internet connection and speeds that you would require to do this now simply just weren't the thing. So they started off by researching and development into creating a streamless platform for live casino streaming. And they had an emphasis on recruiting skilled dealers and developing state-of-the-art environments to replicate these casinos. And they launched their first live casino studio in Riga in 2007. And, this was kind of really the start of their operations. And then along the way, they started off by operating blackjack, roulette, baccarat, and some of these games that really started to get traction. And these were the games that were probably most familiar to physical casino operators. And they kept going, and they come up to 2021, and they rebranded from Evolution Gaming to just gaming. And then I guess it really starts to take off in 2022, which is only 2 years ago, but the introduction of a smart lobby system. So this is almost like a YouTube or Netflix lobby. You've got all the games on a screen, and it's driven by AI recommendations. So, it's similar to Netflix. You watched one show, it'll recommend you then another show to keep you engaged. So Evolution has the exact same functionality. So if you like one of their shows, it'll recommend another. And then they combine this with a one-stop shop. So through the years, Evolution have made a number of bolt-on acquisitions. Okay, so the Next Ent is an RNG company that they purchased. And there's a couple of others. So with this one-stop shop, they can plug in all of their games and any of the acquired companies' games into one, dashboard, and then the casino operators that purchase the service have access to all of their games. So that's kind of the real value prop. You're getting all of their games in one place.
Yeah, for me, it's an amazing story. And even if you think about it, and I mentioned a bit before the show, right? So what do we have in Sweden? We have Avicii, Roxette, ABBA, Spotify, Evolution AB, and what do they all have all have the same here is like really entertainment. And I mean, what is it with Swedish people and entertainment, right? It's unbelievable when you think about it. There is something special to this, and that's somehow there must be something in this industry that now something like Evolution AB pops up. I mean, the company's not even 20 years old. Yeah, they created almost an entire market for themselves here. For me, the innovation that comes out of Sweden in the entertainment industry is amazing, and then also the ability to grow by acquisition already relatively early stage, right? And would you say it's like a technology company? Is how do you look at this company? What's their core asset?
Yeah, definitely. I think it's a technology company that happens to do online gaming, and a big part of that is their intellectual property that they possess. So there's certain games that you can only get through Evolution. So Monopoly Live is one of them, and Lightning Roulette. So if you're an operator and you're not plugged into Evolution, you can't get those games. So then your customers of that casino, you can't get that game. You're probably just going to go to another casino where you can get those games. So it's quite difficult then for competitors to duplicate or to replicate that offering, because they simply cannot provide some of these games because Evolution have IP rights on them. And then as well with
IP, sorry, is it IP rights, or do they have licensing deals with the brand owners of Monopoly, let's say?
Yeah, they've got exclusive deals with Monopoly Live to actually build games off the Monopoly IP.
Yeah, awesome.
And then as well with that, the scale that comes into it. So Evolution are bigger than all of the competitors, and that means that they've got more resources, they've got more users to spread across the fixed cost of developing games. So for example, one of their most successful games recently was a game show called Crazy Time, and this is one of the most expensive online casino games ever built or whatever. So any of the other competitors that are subscale just physically won't be able to build this and do it profitably, because they can't spread the costs across as many users as Evolution. And for example, they actually launched 100 new games in 2023, and I think going back 4 to 5 years ago, they probably were only launching 10 a year. So that kind of just shows the scale that they've got now.
Yeah. So that means also that people in the world have a lot of choice, right? And if you think about that, like, because they do a lot of game production and such, and where are the customers at the moment? Which countries are they very much operating in? Are there certain areas where there's really like a large pickup already? Is it like is it the States or is it China? Where do they earn their most money from?
Yeah, that's actually a great question. So it's a global company. It's everywhere. So I mean, in Asia, you're talking close to 40% of Evolution's revenue is in Asia. Europe has just been surpassed by Asia. You're talking about 35-36% in around that mid to high 30s. North America now is getting pretty big, and that's because of the regulations now in the US. A number of states have started to legalize online gambling, so that's quite a big growth opportunity for Evolution. And then Latin America is another area that's probably only making up about 5, 6, 7%, but it's actually almost one of the fastest growing regions that they've got. So while it is a European company headquartered in Stockholm, it really is global. It's everywhere.
And what is really interesting, so I maybe full disclosure to the listeners, I bought Evolution Gaming, I think in Q4 last year, Q3. And you know what convinced me? The price, of course, was at a really attractive price, around 1,000 Swedish crowns, I believe. But at the time, people were saying like, the growth story is difficult now and such. But then I read in the investor call transcript where the CEO said like, guys, we cannot fulfill demand in Europe. Simply, we cannot deliver on time. Yeah, so it's a supply issue, not a demand issue. Yeah, and that bought me over. I thought like, okay, that means just like when they get the skill or when they fix some issues, they just can continue selling these games. And that's also very impressive, because we don't see that in a lot of businesses, right? Where the CEO is saying like, sorry, I would love to sell more, but I simply can't at the moment.
And that's even with the US having still heavily regulated environment over there. So I believe eventually they will lift bans in all states, and it'll be just like a whirlwind. It'll just take off massively over there. So yeah, it's quite interesting to see how they've actually got into America, and even I'm not surprised with Asia because they're more gamblers. But yeah, the fact that they can't deliver enough software in Europe is incredible.
And just going back to the Europe point that you raised there, EDG, I'd actually just like to touch on something there. And I've got a kind of suspicion, or just kind of my own kind of personal view as to why there might be a supply constraint, or why they can't actually meet the supply. A lot of their studios are based in one country, so like Latvia, and then they can broadcast all over Europe with that one studio. So this is why it makes the operation so profitable. They're scaling it all over Europe, but they're just having maybe not a couple of key studios. My suspicion is that Europe now has reached a level where there's a lot of English language online casinos. And I think now it's the non-English languages that they're probably just taking a bit more time to actually build a studio in a foreign language and get all of that up to speed. Because if you think about it, they have to hire all of the dealers. That's fulfilled by Evolution, and then scale all of that out. So that is my suspicion. I could be 100% wrong, but I have a feeling that's what it is.
You need to train the folks as well here.
Yeah, we can agree with that. We sense that on this podcast sometimes, because we're English speaking, talking to Europeans. We can only speak to English people, or not English people, people who understand English. So I can see that as a real constraint for them. It's understandable. But in terms of Evolution, AB, so they're a tech stock. They pay a high dividend. How do you see them sustaining that dividend while reinvesting for innovation?
Yeah, so it's actually quite a capital light business. So the budget for CapEx in 2024, they've said it, and the earnings call is 120 million. Okay. So in 2023, they did about 1.8 billion of revenue. So that's about 6 to 7%. So that CapEx is quite low, I would say. And in 2023, they actually fell quite below their CapEx guidance because of the supply constraints. They actually couldn't physically go about fulfilling all of the studios that they want to build. So I think this company is in a really unique position whereby the capital requirements are low, but it can still grow quite fast, or at least double digits. So that means that there's going to be a lot of capital to return to shareholders. So they initiated a buyback at the end of last year. I think it was a 400 million euro buyback, and they've been activating that. They've been buying pretty much weekly since then. And then the dividend policy is not a dividend growth policy. So not to get you guys too excited, but they've committed to paying a minimum of 50% of earnings. So I think this year just gone, they've announced something like a 55% hike. So the earnings are growing very fast, and then that presents an opportunity to give the capital back to investors in the form of a dividend. But they're also then being strategic about it. They're not committing to the dividend in case there's an opportunity to make an acquisition, a strategic acquisition. So I actually think it is a good way to go about it. But if you're looking for a committed dividend, or a clear dividend growth policy, it is not that. But provided the company is growing, your dividend should be growing based on the 50% payout.
But I think Derek and I at this stage that we do check the policies, but I would say 7, 8 out of the 10 European dividend policies are a share of earnings. It's not like in America. And even if they say here, like I made a joke about NN Group on Twitter, because they said like, the company reaffirmed its commitment to its progressive dividend policy. But why would you reaffirm each year if you are having a progressive dividend policy? Yeah, like what you're telling me, like that next year you might not reaffirm it. And what does that mean? That means just a dividend cut. Yeah. So in the end, when we look at dividend safety, we need to see earnings or cash flow growth, because in any case, if it doesn't happen, every company is almost then at risk for us cutting the dividend. Maybe some companies, like specifically Americans, are a little bit more loyal to that, like 3M or something like that. But it's the same with Evolution, AB. But you mentioned something about the capex, right? So we can see that also in the headcount numbers, because for instance, for almost a whole year the headcount was flat, and then last quarter they grew like 13% in headcount. Yeah, so it just shows like this company was out of trend with headcount growth, so it showed that they couldn't scale up at that moment in time here. But then the revenue continued to just grow. So I think I looked the other day, and is it now in 3 or 4 years 4 times more revenue, right? Which is
Yeah,
crazy.
I think this is a good segue onto the financials. So like since 2020, so that's 3 years ago, they've actually tripled revenue. So
Tripled, yeah.
560 million in 2020, and they did 1.8 million in 2023. So that's phenomenal, but by anyone's means. So that's even a 5-year CAGR, 49%. And in Q3 2023 alone, they grew by about 16%, which was actually quite low for them, but they actually had a negative impact of 8% on FX. So if you actually strip that out, you're talking, 24% in Q4, and they still managed to grow by 23% in 2023 overall. So, they have been putting up serious growth numbers, and you'd be expecting them to continue to grow by 20% for the next couple of years.
Yeah. And then to your point, capex is only like 8% of entire revenue. Yeah, this reminds me a bit Visa almost. Like Visa has a network in place and is able to generate like 80-90% margins, and I believe their margins are around 60-70%, if I remember correctly, at this moment in time, which is just crazy for such a young company, right? That's what we're talking about here. So it is already at this moment in time, it's already able to scale so much. So it shows just when I look at such balance sheets and financial statements, I just know that they have almost no competition at the moment. Yeah, either their moat is so strong, which I think it is, because to your point earlier, it's not easy to copy this. Yeah, so it's really really nice to see how such an early grower can grow so fast effectively, and that competition can't easily keep up. Because what I understood, there is more and more competition trying this, right, at the moment. And how do you view this? Because you alluded a little bit earlier on it, on the competition as such. But where do you see this company 10 years from now, if you take competition into consideration?
Yeah, so I think with this, because it's still a new industry, really, I think the barriers to entry are low, but the barriers to execution are high.
Yeah.
So anyone could really come in here and try and replicate what Evolution are doing, but they might have 1 or 2 games that they have license to, and then they can plug that in, and they can go to a casino operator and try and offer that, and then Evolution come in with all of their games. It just does not make sense for a casino operator to go with an unproven company where there's probably more risk. Because if the games go wrong, or there's something with fixing, or there was videos of some new gaming providers whereby they hadn't actually studied the floor properly, and there was like a little slant, and people online were basically cleaning them out because they noticed a little divot on the floor. The table was slightly wonky, and all the players were cleaning them out. So the barriers to execution are quite high. But some of the competitors, maybe just to list them off, and the competitive landscape within the online casino area. So Playtech, they're actually one of the only publicly traded companies, and they've been around quite a while. They have some of the bog standard live dealer games as well, like blackjack, roulette, poker, baccarat, and so they're one of the ones that you could compare, publicly listed. Then you've got Vivo Gaming, they're private. Pragmatic Play, they're also private. But I guess these companies are just subscale, or they're doing quite well in certain niches. But across the board, Evolution are I guess the dominant force.
So what you're telling me is like they have a first movers advantage here, and there's also a kind of a I would say network effect happening here as well. Yeah. So because of the whole network they have already, it just people want to be on that network, and it's hard to get out probably as well, like from that point of view.
Yeah, I think the network effect would be definitely another one of the competitive advantages that they'd have. So we've touched on the IP, the intellectual property, I guess, that they have already. So the network effects, they've got the most players. So the social impact of that, there's more players on their games. That's just better for the users. Like, you don't want to arrive onto a game and you're the only player on the table. And they've really tried to make it social. So like those in-chat features, trying to interact with the dealers, interact with the players. If the three of us wanted to play together, we could all jump on the same table on an Evolution game and play together. So, then you have that social aspect of it as well. And I think then the lobby feature, one-stop shop, that really just isolates the network effects that they have. They've got all the games in one area, and you could just be hopping along game to game, and you're all on the Evolution platform.
So we could start a gambler support group and then look after each other, that we don't spend too much.
Yeah, or we could have fun to Dividend.
Yeah, it's interesting to me, especially Playtech here, which I think have been around since early 2000s, if I remember. You mentioned Paddy Powers with Evolution, AB, but I remember when I was doing this with Paddy Power, which is bought out by Betfair now.
Yeah,
Playtech was actually the operator they used at the time, and what they lacked is that social element that you're speaking that Evolution had. You could write in a chat to the dealer, but it was robotic. It wasn't the same. You couldn't chat to other players. So I think maybe that social aspect is probably what's key to all of this, because honestly, gambling can be a lonely kind of world, sitting in a room gambling. But if you can sit there with friends, maybe have a beer online, have a bit of fun, it can make a big difference.
Hey, and I don't know if you know, Wolf, but how's the operator experience, for instance, around the pricing and such? Because sometimes when a company has so much market power, operators may not be too happy with that, right? For instance, too much margin going to a company like Evolution AB. Is there any information around this available?
Yeah, so there's a site you can use. I think it's Live Casino Rating or something like that. I can send it on after.
Yeah.
But you can actually pull out the RTP, so the return to players for all of the games. So on what I would call the core games, so like they're flat across any operator, your blackjack, all like that.
Yeah.
Evolution, highest RTP across the board for any of those bog standard games.
Yeah.
So if you're an operator,
yeah,
that's going to be attractive to you. If you're a player, that's going to be attractive to you. So that's kind of how they get you in almost at the start. They'll give you the best return on these games. And how they can do that is because of, again, we'll go back to the scale. They've got more players, so they can give you the highest return. And I think that's really important to keep the operators on board. And then obviously players are going to love that too.
Yeah.
But then what about regulation? There must be some risks. We're talking about gambling here, and we know that's a heavily regulated industry, which they tend to offshore to like the Isle of Man and Guernsey and all these types of places. But there must be some risks involved here.
Absolutely. There's certainly risks here. So regulation, as you touched on, is a big one. So at the moment, Evolution's most crucial license is with the Malta Gaming Authority, the MGA, but they are also licensed in other EU jurisdictions like the UK and Canada, South Africa. But their model at the moment really involves leveraging 18 studios globally. So they're serving the whole world with 18 studios, and most of their studios are in low-cost countries. So Georgia and Latvia, they've got about 60% of their headcount in those two countries alone. Okay, so the risk is that as Evolution gets bigger and it keeps putting up these profits, regulators come along and see these guys have got 60% operating margins. I want some of that. Okay, so what they might start doing is they'll start having you'll have to have a studio perhaps in a country, and this is the way it is in the US. So in each US state that Evolution operates, it has to have a studio in that state. So you can imagine the cost to operate in the US, even with just salaries for the dealers and stuff, are going to be a lot higher. So that is a big risk within the established countries in Europe. I would say that if they have to go and put a studio in each European country, that would erode their margins. It would not be the same business. Now it could be a growth opportunity in another way, but that's a big risk to the margins. Also, the income tax rate. So at the moment, they're availing of a low corporate tax rate in Malta of about 7.5%, but we know that this is going to be 15% within the next year or two because of the global minimum tax initiatives, and management have discussed this. So like that's the tax rate just doubling there pretty much overnight. That'll impact free cash flow that you can return to the business. Another risk that I would like to touch on just while we're on this is the customer concentration. So at the end of 2023, their top 5 customers make up 41% of revenue. 41% from 5 customers. So that is very, very concentrated. So if you think about it, even if they were to lose one of those major clients, like you could be talking 7-8% of revenue just going on one client there alone. Now, I would caveat it that you might think, well, how could it be one casino operator producing that much? Some of these clients are actually what we'd call gaming aggregators. So they actually aggregate online casinos together, and then you go through one aggregator, and then once you log in once, you can log into all of the individual casino operators. So while it is a risk, it's not then maybe as severe as you think when you first read it because they're casino aggregators, but it is still a risk. And then another risk that, definitely people would say, well, they're making all of this money. Why wouldn't the casino operators just in-house this solution themselves and, not pay Evolution their share of the, profits that they're getting? So the biggest one here is the expertise and cost effectiveness that Evolution have. So if a third party provider were to build this, they'd be starting from scratch. Evolution have been doing this for 15 years. Can you imagine how long it would take to build out the entire platform, all of the games? Like, you're talking years here. It's not going to happen overnight. The other benefit then is that if you were developing new games in-house, you're just spreading those costs across your players, which could be, even if you're the largest casino, how many players percentage-wise of the total do you have? Whereas Evolution are spreading all of the costs across 100% of the playing population. So, it just makes it way more feasible. The other thing is risk management. You use Evolution, they take on all of that. They in-house the development, they hire all the staff, they run all of that customer service. If you were to in-house it, you'd have to do all of that. You'd have to hire all the dealers yourself. You'd have to train all the dealers yourself. You'd have to manage all of that risk. So there's quite a few reasons why these largest casinos haven't in-housed it, even though it is a risk.
Yeah, makes sense. I mean, even if they decided to develop them themselves, they'll always be playing catch up. Always, because technology moves on. They'll catch up with Evolution today, but Evolution will be after moving on by then. So
yeah,
I could see that. But where do you think their greatest opportunity lies? So
yeah, and I think it's just to do really with the global market growth of online gambling. So the market is projected to reach 154 billion by 2030. And that's a CAGR from today of 12%. So that's just the market growing, driven by factors, smartphone adoption and internet penetration. So, everyone's got a smartphone now. The internet penetration is improving not only in the developed worlds, but in then, Latin America, Asia, some of these countries, they're now coming on board because they've got the internet model. So there's really just a global tailwind there that the market is going to shift from land-based to online.
And maybe a question from my side, like, how do you look at this morally? Because Derek was mentioning already, like, gamblers and effectively want to give them even more screen time like this. They can do it from home. How do you look at it as an investor morally, right? Because we talk a lot about sin stocks from time to time, like tobacco stocks. What is your position on this?
It's a great point, and I can see why some people would not like to invest in this company, due to those moral reasons. You compare, as you said, to tobacco stocks, but I try and not let my moral compass get involved with my investments. I think even if evolution isn't here, there's still going to be gambling of some sort. So I don't think, if you just get rid of evolution or you stop investing in evolution, that gambling is going to go away. I think that's just human nature. People, playing poker together, that's technically gambling. Friends meeting up on a Friday for beers, playing the game poker, that is technically gambling. But I do take your point. Morally, is it the best company? Probably not. But that's probably one of the reasons why it might trade at a discount, and why you might not see some of the ETFs that are, you've got anti-sin stocks or whatever. They won't include those in their ETF. So
well,
is a
but if they
relevant
would put the operators in a nicely insulated, climate-neutral building, then I would think it will score a lot of ESG points, right?
Absolutely.
Yeah, there's no doubt this, to me, is a sin stock. I mean, there's no question of that. But I'm with you, Wolf. I don't let my moral compass judge my ability to make money. So, I mean, gambling's going to be there whether I invest in this company or not. I'm small fish. So I have no control over that. But you have to say straight out, this is pretty much a sin as you can get when it comes to investing.
Yeah.
I'm long evolution to declare my position on this as well, but I would never invest in Vici. Yeah, as hypocrite as it can get.
we do have some questions from our listeners around evolution as well, so we might just ask one or two of those if you don't mind.
Yeah, sure.
And Dividend on has asked about your thoughts about their capital allocation. Would you like to see more buybacks, or would you like to see higher dividends?
Yeah, so I think this is a good question, and it's one that has the community divided in some respects because of their capital allocation strategy. So, one of their largest acquisitions I mentioned that was 1.8 million, and they did that through a share dilution program. So that actually diluted their share count quite a bit. So that's just something to bear in mind, that they do look to keep their capital for acquisitions. But I think at the current valuation, they initiated the buyback 400 million at the end of last year. Evolution was trading at a forward PE of about 16, 17. And they've just been buying every week. And I think that's really, really smart. Like low teens, high teens, low 20s PE. I think a buyback makes so much sense. And I think this company really has the potential to turn into a share cannibal, because as I mentioned already, the capex requirements are quite low to grow. So they're going to have excess capital. So they can either return it to shareholders or a dividend, or do a buyback program. And I have a feeling that this probably won't, I could be wrong now, this won't ever really get elevated in terms of PE again, because I think it's based in Europe. And that's, whether you want to call it a bad thing or not, we don't get the same premiums as if this was traded on a US exchange. So I would definitely like to see the buyback continued. Not at any valuation, but I think if you're low 20s PE, teens, I'd be having that buyback all day.
I must comment on this because I believe this company doesn't have a lot of debt, right, on the balance sheet. I'm looking here. It has total non-current liabilities of 400 million and total equity of 4 billion. Yeah. So, and then total, what is it? Cash and cash equivalents is also about 1 billion. And then I mean, this buyback, that was also one of the convincing things. And in our newsletter that we have, I even made a comment there, like that I really would like to applaud the CEO for doing buybacks the Buffett way. Yeah, he just said, okay, this is coming too cheap. Let's buy a lot. And you don't hear this a lot. Usually they just turn the buyback machine on the top of the market and the next tops, but not when they're at the bottom, which was clearly there. And for me, was also a very bullish signal at the time that they really turned this on.
Yep.
It's good that you mentioned actually trading as a premium on the US exchange, because Dave Madison has asked, what kind of valuation would Evolution be if they were listed in the US?
Yeah, I can't give you a specific answer, but I could definitely tell you that it would be higher. And I think that's just the premium with the US.
I think it would definitely be double, easily be double. If you look at CRH, they
Yep.
moved from the London Stock Exchange to the US Stock Exchange just recently, and they've doubled in share price in that time. I mean, it's just the power of that exchange and that market over there.
Yeah, and like just to kind of highlight some of these financial numbers that maybe we haven't kind of touched on already. So it's grown 20% plus, an EBITDA margin of 70%, 70.
Yeah.
Free cash flow margin of 60%. Like, that is incredible by anyone's stretch. I don't think I've another stock that I've studied or come across that has 60% free cash flow margin growing at that scale as well. So it's incredible, really.
Yeah, those sort of margins are, as you said, normally linked with the big tech stocks, and
Yeah.
I mean, these guys are coming in and smashing it. David had asked, why would you choose Evolution over a company like Betsson?
Yeah, that's a good question. So I would classify Evolution as the picks and shovels play in the online casino market, whereas Betsson are actually one of the casino operators. So the disadvantage that the casino operators have is that they have to go out and acquire the customers. They have to go and attract the punters. They have to try and get me and you onto their platform, their online casino. Whereas Evolution has got zero customer acquisition costs. It doesn't pay to get the punters in. It just provides the software, the service to the operators, and then they go out and have to attract the customers. So I think that's the biggest advantage that Evolution has over any of the casino operators.
And we got one last question on Evolution, and that is, what are the possible negative sides of the business, which I think you've discussed, but what could affect them not to grow?
Yeah, and we've touched on some of the risks, but I guess I really think it's regulation. Could you envisage a world in where gambling is banned in the future, similar to smoking, countries banning smoking? Possibly, but looking at the revenue now, it's going the other way. Like, I mean, you're seeing regulation allowing online gambling, and it's because the states in the US in particular see the revenue that it's going to bring in for just overnight. Like, you're talking billions of revenue that will be coming in to the US states simply by regulating this. But that is a risk. But I think stopping it growing, I don't think the risk is it's not growing, but I think the risk is that the margins get compressed materially, and I think that's where the risk really is for me. If you compare it to the big tech stocks, like, as this company grows and more regulators start looking at it, I think it's going to come under more scrutiny, because you're going to see the margins that it's posting. So I could see the margins getting a haircut as the biggest risk.
Yeah, makes sense. Yeah, so that's pretty much the last question we had. Is there anything else about Evolution that you'd like to mention that maybe we haven't asked you or commented on?
Yeah, I think maybe just touching on the operating leverage, and we probably haven't kind of explained that in detail, or just kind of given the listeners really a flavor for that. So if I just touch on maybe the operating expenses in 2023,
Yeah.
So about 655 million, and that equated to an operating margin of north of 60%. So their major costs here really are the personnel, so your dealers, stuff like that, your facilities and studios, and then I guess product development, so developing new games. So the operating margin from 2014 to 2023 has gone from 27% to 64%. So how really have they managed to do this? And it really comes down to the scalability advantage. So the dealers are essentially fixed costs. So a certain amount of dealers can almost serve an unlimited, not unlimited, but technically unlimited a number of players. So more players coming on to a table, it's just pure profit, because the dealers' cost is fixed, and as they add more dealers, then it's just compounding the leverage effect. And then as well, the zero customer acquisition costs. This is just so unique. an advantage that they don't have to pay to acquire customers. It's the operators that have to go out and do that. So yeah, that's kind of really what's contributed to this, to the margins. You've got the scale advantage, fixed costs of live dealers, and then the zero customer acquisition costs.
Yeah, nice one. Look, I think it's a nice overview of Evolution Gaming. I have to say that on paper they look strong. Their margins are incredibly strong, as we mentioned. Very little debt. They pay high dividend, growing dividend based on earnings. I quite like that model, I have to say. I prefer that over the US version, because you know what you're going to get. If earnings are slowing down, you can predict what your income will be. But yeah, it's a definitely a nice company. I'm not invested in it. Full disclosure, I know European DJI is, but it's an interesting company, and one on my radar.
Yeah, and obviously, just for disclosure, I'm also a shareholder. If that probably mightn't have been obvious.
And maybe for people that are interested, it is now trading for 1,340 Swedish crowns. And I believe you can still get it for a current yield of 2.2%. I know many people shy away from the Swedish dividend tax of 30%. So if you look at the tax-adjusted yield, it would be like 1.5%. But then again, it grew with 32.5% in the most recent hike, which is something we don't see a lot. And yeah, if it could do this 2 or 3 times more, you quickly double the dividend already. And this typically for me, actually an example of where I would step out from a 2.75% yield, because the minimum requirement, because the growth is there. And we spoke a little bit like about how it would have looked like on if it would be trading on the US exchange. I think Evolution AB, for me, it's now already a bit too expensive, but I'm a Scrooge. Yeah, but generally speaking, this is one of those very rare opportunities where you get a decent yield to start with the proper growth with it. Yeah, we're not talking about Apple here at 0.6% yield with a lower growth rate. Yeah. As well. So one of those unique opportunities that you may buy on the dip, if it will ever dip again.
Nice one. We have a couple of other listeners' questions. I might just ask them if that's okay. And Hugo, I think this is more related to you, European DJI. Last week you mentioned a supermarket, Biedronka.
Biedronka.
Yes, of course I'd say it wrong. But have you ever checked out the company that owns that? Apparently it's the Portuguese Ahold.
Yes, I did. Jerónimo Martins. I checked that, but it's a dividend cutter. Yeah, so yes, of course. I mean, I'm like this. For me, everything is a stock safari. So when I'm in the bus, I'm looking at the brand of the bus. If it's a Siemens tram or a train, right? So the same supermarket chains. I, by the way, saw a Dino Polska in the neighborhood not too long ago. And I was talking with my wife about it. She's born and raised here. She had never seen a Dino Polska, and she wondered, like, why is something called like a dinosaurus? So, but I just want to share this because I know internationally it's seen as a high growth company, but I think it's mostly outside of the cities, in the rural areas here, and it's probably in competition with a company like Biedronka. It's very interesting that a shop and a chain like Dino Polska is popular on the stock market, because when you see the building, it's the typical kind of shop that doesn't appeal you to even go inside. But probably they're very clever by being in those areas where maybe it's not easy to get to logistically because it's a big country. Yeah, so maybe it's doing this really smart that they found like a gap in the market there. But for me, with this association, I can just not understand like why I would ever buy at such shop unless I live there. But yeah. That's the issue with proximity bias, right?
Yeah, exactly. And I've seen that building. We passed it together, actually.
Yeah.
So I get what you're saying. It would not entice me to go in there at all. But yeah, as I said, I'm not from that area. JC has asked us about our thoughts on NextEra Energy, ticker symbol NEE. Any of you have any thoughts?
Yeah, I don't know it well enough, but I think
Jeremy.
Jeremy was writing about it, and I think it's a very, I said, a stock that creates like discussion a lot, right? The question is the dividend safe or not? Aren't they too aggressive with the dividend growth and such? So, but I have never analyzed it.
Andrew has asked Wolf a question, and he wants to know about your chart patterns. So he obviously follows you on Twitter, and for a newbie investor like Andrew, it seems like you're doing some sort of tarot card reading or voodoo black magic. How much faith do you actually put into such patterns, and how might someone learn these dark arts?
Yeah, this is a great question, and I just take a step back and first maybe explain my own
Please.
strategy of how by researching a stock and where then that chart pattern actually fits in. So my first step is your fundamental detailed analysis. So going through the financials, understanding the competitive advantages, the competitive landscape, and all of that. So figuring out, regardless of the valuation, is this a good company? Do I actually want to own it, regardless of the price? So figuring out, does it have a competitive advantage, all that sort of stuff. So once I've done that, then I'll move on to the valuation. I'll do my discounted cash flow valuation, looking at PEs and stuff like that, and then I'll come up with a valuation that I would like to own it at, or a range. So if it's obviously trading below that, I'll initiate a position, like for example, an evolution late last year. And the final part then is the wizardry of the charts. So really, this is just the cherry on top. You're just looking at the overall trend of the stock. Is the stock trading way above its moving averages? Because generally, what goes up must come down. So it's purely just looking at that. Is it hugging the trend lines, the 200 to 50, just to see if it's in a an upward trend, downward trend. So it's really just looking for me to get an entry point, but it's the last piece of the puzzle. And I don't start with the chart and say, oh, this stock is moving towards its 50, 200. I'm just going to buy it, and I don't even know what the stock is. So I'm a fundamental investor at heart. But at the same time, I do like to try and consider all of the available data, and I do think that charting is a small piece of that.
And do you have any resources, recommendations, or books, or where would someone start if they wanted to?
Yeah, there's actually quite a good stock, William O'Neill, How to Make Money in Stocks. But it's a great book, but it is slightly more aimed at traders, which I'm not. But that is one way that it's a very good book that I would recommend if you're looking to get into charting.
Yeah, good. And then the second part of Andrew's question is, what have you invested in recently?
Yeah, so the last stock that I invested in was about a month ago. It was actually at the start of February, and it's New Holdings, ticker NU. So this isn't a dividend stock, so it might not interest all your listeners, but it's a neobank in Latin America. And the reason here that I'm probably interested in this area is that I spent 3 months traveling in this region in 2022. So I actually got to see up close and personal the challenges that they have with digital banking and stuff, and there's just such a massive gap in the market there. I was able to see that something like Nubank, it's just taken over, especially in Brazil. So I'm bullish in South America in general, and it was just good to have that personal experience there as well.
And is there any company you're considering to invest in?
Yeah, so another one that I invested in probably the month before that is actually a European stock, and it pays a dividend. It's Auto Partner. Okay. Ticker APR.WA. And this is a distributor of spare car parts based in Poland. And it's listed on the Warsaw Stock Exchange. Really nice company, really nice financials, good return on invested capital, nice growth rate, some secular tailwinds whereby they're doing really well exporting out of Poland to the European market. The dividend was only initiated last year. Essentially because the owner owns about 50% of the company, and they're just looking for a way to get some cash out without selling the shares. So a really nice company, but not necessarily a dividend growth stock, but I think actually a really nice company to research. I have a report on that company after its most recent earnings as well. So if anyone is interested, that's up my website as well.
Perfect. Yeah, if you shoot us the link, I will get the link. We'll post that with with this podcast. And then Ronnie has asked us, how far into the past do you take the payout ratio into consideration?
Well, actually, I take the current payout ratio mostly into consideration. But what I do look at is like, how did the company perform during a recession, and what did it do to the dividends? And that's what I find really important, because if, for instance, the balance sheet was good at that time, I expect a company to continue the dividends and have the own confidence in their own strength, right? If they're hovering out around the 100% payout ratio. So I do expect some more commitment there, but generally I look at the payout ratio today because what I just want to know is there enough margin of safety for the dividend to continue paying it? That's really the question that I ask, and why this is important for me.
Cool. Okay, thank you. That's all of our questions. So thanks a lot to our listeners. Wolf, thanks so much for coming on the show again. It was a really interesting chat with you. Actually, your knowledge around that company is quite something. You've done quite a bit of research, so we really appreciate you coming on.
Yeah, guys, just thanks a million for inviting me on. It was an absolute pleasure. Even though I've appeared on the podcast, I'm a regular listener to the show as well. So I just want to say, keep up the great work, and it's one of my most regular listens.
Nice one.
Thanks, Wolf. And we'll make sure also we share some links to your profiles, to your blogs, that others can read up more about it. Thank you.
Okay, and to our listeners, we'll see you all next week. Remember, both of us at Dividend Talk are not certified financial specialists through formal education. We are just two guys sharing our journey for inspiration and entertainment purposes. Hence, this is not investment advice. Although we do our best, we can't promise that the information discussed is always correct, nor appropriate for you or anybody else. We always recommend that you do your own due diligence and be accountable for your own choices. As we always say, you can't borrow conviction from others. Last but not least, by listening to our podcast, you agree to hold us harmless from any ramifications, financial or otherwise, that occur to you as a result of acting on information provided in this podcast.